Very warm welcome to all the participants, panelists, and the presenter on the weekly Saturday webinar, what we conduct on behalf of Mehta and Mehta. It is my pleasure to have you all over here. So, the topic for today is the burning topic around this time of the year, which is an insight into the board report. I know this is a time where everybody, would be now pulling up the details for the entire year and drafting the board report. So that's why we thought that it's the most relevant to have this webinar at this stage. And as a presenter, we have Ms. Pragati Jaiswal and our esteemed panelist, Mr. Amit Gupta ji. Everybody would have heard about him, seen him, heard webinars, seminars from him at some point in time. He's a very well known name in our industry in the CS profession. So, Amit Gupta, sir, is a fellow member of the Institute of Company Secretaries of India and an insolvency professional. He's passionately been engaged in this profession for the last 23 years in corporate and allied laws and providing out of the box solutions on complex legal and strategic management issues. Mr. Amit Gupta has also contributed extensively to the profession and the society towards various roles that he has played in ICSI, including being a member of the NIRC, ex officio member of the Management Committee of the Lucknow chapter, and the chairman of the Research and Publication Committee for ICSI. He has also served on the Secretarial Standards Boards, the Accounting Standard Board, and several core groups and task forces on behalf of ICSI. Outside of ICSI, he's a member of the Corporate Law and Corporate Governance Committee of PhD Chambers and the National Council of ASSOCHAM on mergers and acquisitions. His publications include the ICSI Premier on Company Law, Voluntary Liquidation, and Handbook on Interim Resolution Professional. His key contributions include Vision New ICSI 2022, Compliance Management and Audit Configurator, and the new syllabus for the executive and professional program. He's also a visiting faculty and a regular speaker at various institutes and conferences. A very warm welcome to you, Amit sir. It's a pleasure to have you. We've had you before on this on Mehta and Mehta webinars, and it is always a pleasure to have you back.
Thank you, Jasmine. Thank you, Mehta and Mehta.
Yes, our presenter for today is Ms. Pragati Jaiswal. Ms. Pragati is an associate member of ICSI and has gained extensive practical exposure on corporate governance, secretarial, and regulatory advisory related matters. She is associated with Mehta and Mehta and handles secretarial and regulatory compliances for listed public, private companies and PSUs. Of course, we have with us Sudhakar sir, our chief consultant at Mehta and Mehta, who is always there every Saturday to guide us and give us valuable practical inputs and interpretation on law. Welcome Sudhakar sir and Bala sir, the one who moderates and takes everybody's queries, intriguing queries in an appropriate manner. So thank you so much. And with this introduction, Amit sir, I would like to hand it over to you to say a few words on this topic before we begin.
Yeah, Jasmine, I think very aptly chosen, and especially the timing in which the session is organized is going to be very relevant. There are multiple issues which keeps bothering, although the board report is subject which is very core to the heart of each professional, especially the company secretary, and everybody is well versed. So I'm sure the audience is going to be very excited to see as to what is going to be unveiled today in this particular session in 2 hours, what new they are going to learn. Maybe the new perspective and certain critical issues are going to be thrown for the discussion, and I'm sure each one will benefit out of this.
Over to Sudhakar, please.
Thank you. Hi, good morning, everyone. Good morning, Amit. Good to see you once again. And friends, in fact, today I was thinking that how many participants will be there because the PCS conference is there at Pune, and it is also, in fact, one can participate through the virtual mode also. So I thought, but the topic is such an important one. We are already having about 185 participants are there in this. In fact, board's report, when I was in Reliance, I always used to tell my people that never ever take this particular report as if it is an usual keep that cut paste kind of thing. Because board report is a very important thing. It is a legal document wherein you have to give the furnish the information, whatever it is stipulated in the act, and no forward-looking statements, no justifications, no reasons. Reasoning will be there in the board report. That is a very very important thing. Second thing is that we have Secretarial Standard 4, which is not, of course, mandatory. It is a recommendatory. And with all due regards, I don't know how many participants would have read this SS4 and how many are really even know that SS4 in existence. The reason being, it is my experience whenever I used to deal with discuss with the or talk to the professionals. The things which are mandatory, they are lacking in understanding of those mandates like SS1, SS2, and other guidance notes. So the experience was not very encouraging. So SS4, I don't know. But my sincere advice, request, and submission to all the participants is please do give a reading to the SS4. And whenever you prepare the board's report, unless until you go through this SS4, because a lot of efforts we have put in there while drafting this. In fact, Amit was there along with at that time in SSB. He also very well aware of that amounts of efforts what we have put in. Unfortunately, the provisions under which you have to furnish the information in the board's report are scattered across the Companies Act. They are not in under one particular section. Similarly, in the listing regulations, also same is the case. It is not. It is completely scattered everywhere. So one need to be very very careful, because even if a small thing which you are supposed to furnish the information, if you are not furnished it, leads to a non-compliance. In fact, I don't remember exactly which was there, and I have seen one of the ROC adjudication matters wherein they have not given the constitution of the audit committee. That means that the names of that audit committee members are not given in the board's report, which was taken as a non-compliance. Though it may be a very silly mistake, because one can say always in my header of the annual report, we have given the committees, we have given the names of the committee members and all those things. Second thing is that recently when I was interacting with one young company secretary having about 5 6 years of experience, he was telling, sir, chat GPT is there, we don't need to worry for all these things, sir. This is the most dangerous thing according to me. It is a landmine virtually. AI tools are enablers. AI tools are not the replacement to the professionals. If you prepare a board report based on the chat GPT, this chat GPT, and if you want to relax, only God can save you and your company. So with this, I give a pause here, and during the presentation of Pragati, we will deal with further. In fact, I got an opportunity to go through Pragati's presentation. It's one of the excellent presentations I have come across, and I'm sure that all of you will get benefited with this. Thanks, Bala, and back it to you.
Good morning to all of you. You heard from our panelists the importance of the board report. What are the things which have to be? Mr. Sudhakar touched upon very, very vital point. It is not the report just a cut and paste, or we just to do it or something like that. In fact, for preparing the board report, especially in a companies which are involved in multiple activities, the larger companies, we need to keep a track throughout the year, because we cannot suddenly remember the year of the year what has actually happened. Maybe, some issue might have happened place from RBI, etc. The notice would have come that is worth reporting it, which unless we take a notification, we are tend to, slip it out. That could be the case actually. So the board report periodically one has to keep a track. That is one thing. Second thing is, it is not only the board report which is talking about, people will be thinking, oh, it is only section 134, subsection 3 talks about the board report, what ought to be included. It is not so. As Sudhakar puts it, it's all scattered around various sections of the Companies Act, number one. And it is more for the public listed company. Also, it is as per the LODR regulation. In addition to that, there are sectoral requirements, especially certain other things which has taken place of things, wherever the sectoral things are covered, that is also to be included. For example, MSME detail is to be given by all the companies if they are dealing with it. Post requirement, that is to be given by the companies. So these are all not actually coming under the Companies Act. Similarly, if the company is involved in the insurance company or other chemical related company, other mining company, etc., and all, there are specific requirement is actually there. As Sudhakar puts it, Our presenter Pragati has actually nicely put it. What are the various regulatory things? She is actually covering this also in her presentation. As she rightly said, this is, I think, she has precisely, very aptly prepared a very good presentation. Actually, I think as we go along, you will appreciate that. So I leave it here because the board report is known to every company secretary involved. So they know it very well. So I will not take much of a time on this. We will leave it here and we'll start going. As usual, I request the participant to put up their queries and questions on the chat box so that we will be taking it periodically. So I leave it here. I ask Pragati to take over the presentation. Over to Pragati.
Okay, thank you, sir, for your kind words. I will just be sharing my screen for the presentation.
Yeah, it is visible. Put it in the presentation. Yeah, perfect.
Okay, so good morning, everyone. I am CS Pragati Jaiswal, Secretarial Officer at Mehta & Mehta, and I'm pleased to present today's session on board report. So let's look at our today's agenda. We will discuss the regulatory frameworks governing the board report, key disclosure requirements under Companies Act, the structured reporting framework prescribed under secretarial standard, additional obligation applicable to listed entities and other acts as well. Then we will go through the recent regulatory developments and practical lessons emerging from the enforcement actions and case study. So with this, let's move further to our next slide. So what is a board report? A board report is a statutory report prepared by the board of directors and presented to the shareholders along with the financial statement at the annual general meeting. Think of it as a board official communication to the shareholders. While the financial statements tell us what happened financially, the board report explains why it happened, how it happened, and what risks were faced, what governance mechanism were followed, and what lies ahead. So it therefore acts as a bridge between the numbers reflected in the financial statements and the management's perspective on the affairs of the company. So the primary governing provisions, as rightly said by our mentors, are section 134 of the Companies Act, along with various other sections in the Companies Act and the rules and regulatory requirements. So now that we know what is board report, let us understand why it is considered as such an important document. So the importance of board report varies from stakeholders to stakeholders. For shareholders, it provides transparency and helps them to understand the company's performance beyond the financial figure, as for regulators, it serves as an evidence of the compliance, and also it assists in the monitoring governance practices. While for the directors, if we see it, the board report might be one of the strongest indicators for the quality of the corporate governance within our organization. In that way, they are able to convey the shareholders of the company, or rather than stakeholders, that they are good at their job. So if we move to the next slide, we now know what is board report and why it is important. So given its importance, there might actually be a proper regulatory framework which governs the practicality of the board report. And if there is one vital key takeaway from this session, let it be this: reliance on section 134 alone may result in incomplete disclosure. So a compliant board report requires simultaneous and harmonious reading with the other sections of Companies Act, its rules, Secretarial Standard 4, SEBI LODR if the company is a listed one, and other acts as well. Moving to the next slide, if we are going about the disclosure, what I mentioned in section 134, before going to that, we should know what are the core provisions provided in this section itself. So the section starts, the backbone of the section covers four critical aspects. First is the preparation of the report. Second, the approval by the board. Third, its authentication through authorized signatory. And fourth, the disclosures that must be included. Now, if we come, disclosure is covered in the last part of the report. First one is preparation, which itself starts with the financial statements. So, section 134 subsection 1 says about financial statement that it has to be signed by 2 directors plus with CS CEO or CFO if the company has any. Section 134 subsection 2 says that the auditor's report shall be attached to every financial statement. And section 134(3) says the board report should contain all the prescribed disclosures, whatever mentioned herein. The section also says about director's responsibility statement. Then it says the applicability of the section to the government companies. And finally, it says about how the board report must be approved and signed. The section also prescribe about the non-compliance consequences if company faces any, if they have not complied with the following sections. Now that we have understood the foundation of the board report, let us now move to the heart of
Just
the
1 minute,
board.
Pragati, 1 minute. Just go back to the previous slide. See, when this board's report is to be approved by the board of directors, normally what happened is if you see the agenda items, you will have the approval of financial statements, and after that you will have approval of the board report and other reports, and then the AGM notice, blah blah blah, like that. About 2 3 weeks before, somebody questioned me just to know that the agenda was circulated for whatever the reasons it is. They could not get the auditor's report. The final draft, they couldn't get it. Auditors have come to know something after circulation of the agenda, so they have withheld the auditor's report. Now their question is that they want to go ahead with other agenda items except the approval of financial statements. Question is, can it be done? And how can you do it? Because you cannot approve the board's report unless until you approve the financial statements together with the auditor's report. The reason for that is if any qualifications or observations or explanations are there in the auditor's report, you need to clarify that in the board's report. So the answer to that was unless until you approve the financial statements together with the audit reports, you cannot approve the board report. So you may have to adjourn the meeting, and after that you have to take up all the other issues. Now the question is that what I can do, what I cannot do. You have to see that which are the and okay, the agenda items have interconnection. What you can approve, what you have to defer, that is up to you to decide it. Amit, in case if you want to add anything to this.
Yeah, absolutely. Very valid point that you have highlighted. I just wanted to highlight one more important aspect with regard to signing. As 134 allows signing of board report by the chairman. Now, one of the common mistakes that we have observed while doing the audit and otherwise, that even though company is not having a chairperson, what they use is they get the board report signed by the chairperson appointed for the meeting. The mandate under 134 is not the chairman appointed by the meeting. If your company has appointed a chairman either by shareholders in terms of your articles of association or by the board of directors, who is called a chairman of the board, then only you can delegate the power for authentication under section 134. If you have appointed or elected somebody as a chairman for the particular meeting in which the board report is presented, he cannot be validly authorized in terms of 134 for the purpose of signing. That is one point which we keep telling to the people, and we keep observing still the kind of mistakes are continuing. One more point, just to add to what Sudhakar sir was mentioning. See, I have seen the time in early 20s when the annual report was divided into that time also into two parts. One was financial data and one was non-financial data. The situation was like financial data was 80% of the annual report and 20% was the other qualitative information, right? Including the board report and few other pages. In 2025, 2026, the situation has reversed. Companies are having so much of qualitative data, be it requirement from the listing regulation, be it otherwise, that everybody wants to showcase and present the company's branding, the company's statutory disclosure, and the other things in such a manner that your company's reputation, image, and transparency and disclosure comes to the fullest clarity. BRSR report, integrated report, and so much of integration has been done with regard to the qualitative data that this report has become a prime importance for the company secretaries. And it is not, as Sudhakar sir was highlighting, this is not a very straight agenda. When you are presenting to your board of directors the approval agenda for board of directors report, each and every item may have its own merits, and we may take a full day for deliberating on each an item, right? I'm just giving you a highlight. Like, one of the prime important responsibility casted in the board report is the director's responsibility statement, which is direct responsibility on the head of the individual directors. Directors are certifying with regard to those 5 or 6 points, and how much attention is paid, only that it is a part and parcel of the board report. That's it. Have we ever verified whether there is a qualification by the statutory auditor on the accounting standard? Your, on one hand, statutory auditor is giving a qualification on the accounting standard compliance. On the other hand, your board responsibility statement is saying a contrary picture. He is putting question mark on the internal control system. We are saying that our internal control systems are. So what message I am trying to give is we need to pay a bit of attention to whatever disclosures we are making. So my agenda should be drafted accordingly so that appropriate disclosure and what supports you have for giving a comfort to the board of director that yes, we have done a back checking and there is nothing which can give a discomfort to any of the director while making these kind of declaration. There is a declaration with regard to the risk. Many companies don't have anything on the risk parameter, and we still continue to give the disclosure with regard to the risk. I'm not pointing out anyone, but what I am trying to say, we need to pay a bit of attention while including these clauses in the director's responsibility statement, create a backup, and this will add a value to each and every professional when you will present all that to the board of director that yes, the company secretary has done these kind of homeworks and he has done collection of the document and data from that other respective department. And then they are coming back to us. This is a small point. You can continue, Pragati.
I
But
mean,
in
there is
fact,
a
Amit,
question. There is a question is there. Can there be a chairman of the board only and not the chairman of the company? Is it so?
Yeah, possible. There could be three kind of chairperson position. Sudhakar sir can correct me if I'm wrong anywhere. There could be a possibility that your articles of association directly prescribes that who will be the chairperson. And they generally prescribe that the chairperson will be one who is elected or appointed by the shareholders of the company from time to time. Alternatively, they can provide that the board of directors will have a power from time to time to elect one among themselves as a chairperson of the board. These two, if to the best of my understanding, will be qualified for the purpose of signing a board report on behalf of the board as an authorized signatory. The person who is appointed as a chairman in a meeting from time to time for a particular meeting or maybe for all the meetings even, still he cannot qualify. That is my view. Sudhakar sir.
yeah, I agree with you, Amit. In fact, as you rightly said, in the section 134, the word they have used is the chairman of the company who has to sign the report. It is not the chairman who has to sign the report.
Correct.
So chairman of the company means the company has to have a chairman. Under the act, it is not mandatory. A company has to have a chairman of the company. But normally companies do appoint it. As you rightly said, one way of appointment is by the approval of shareholders. Second thing is not normally we find this clause only in the articles that the chairman of the board is the chairman of the company. In such case, if the board is having a permanent chairman elected by the board of directors, he will become the chairman of the company. In such case, only that chairman can sign the board's report. Otherwise, if you are not having a chairman of the company, but you are having only a chairman of the board, neither your shareholders have appointed, nor your articles is about silent about that. In such case, you have to authorize two directors to sign that report. Second thing is that Amit has very aptly pointed out about the director's responsibility statement. In fact, in my training sessions to the directors, I always highlight this particular point to the independent directors. Whenever the board report is presented, please go through that director's responsibility statement, because you all are collectively giving. The word itself is director's responsibility statement. So those 5 or 6 affirmations, what you are giving in the director's report, or in the board's report, you have to take the ownership of that. So you should be very clear. Normally, see, that's why I always request our fellow company secretaries is that please don't prepare the board's report as a mechanical report, and don't do the cut pasting also. Normally, what happens is whenever we have to prepare documents, we prepare the previous year report, cut paste, and then do like that. Every word, whatever it is going into the board's report, you have to vouch for that thing as the compliance officer or company secretary of the company. Similarly, signing part, one more thing also is normally we always get this thing is only the board's report to be signed by the chairman or the directors, or all the annexes are also to be signed. All the annexes are part of the board's report. Whoever is signing the board's report, they have to sign all the annexes also. In fact, only report which is that CSR report is to be signed by the who has to sign the CSR report. It is prescribed already in the rules. That's why it is to be signed by the chairman of the CSR committee and one more director. If he is a managing director, he has to sign that. I don't remember, but recently I have seen 126 this financial year's board's report of one company, where the CSR report is also signed by the chairman of the company who has signed all the annexures. In fact, according to me, that might be one of the correct way of doing it also. If at all it is not signed also, there should not be a problem. We can always take a plea that 135, that CSR report is who has to sign that. It is already prescribed in the rules. So only those people have signed it. That is fine enough. Over and above that, if it is signed by the chairman of the company or the directors who have signed that, it will be a good compliance.
Somebody is asking, can we get the financial statement approved in one board meeting and the board report in the subsequent board meeting?
Quite possible. Why not?
Possible.
Many times it happens. I have seen in the company, actually, what happens is the financial statements are actually adopted. And then what happens is it goes to the auditor's signature, etc. The board is actually getting adjourned. And the next day they assemble only for the purpose of approving the board report. That also I actually seen it. That is one. Second thing is, as Amit puts it very clearly about the chairman, I have seen in many of the foreign collaborated companies, the article itself provide what you call the chairman of the company and also a position of the vice chairman of the company. Because many times what happens, the chairman of the company generally come from abroad, the people who are actually there, the parent company. So what happens is whenever he is not there, they always have a vice chairman who is actually there in India. That is there in article itself says in the absence of the chairman, the vice chairman will actually chair the meeting. That is used to be the case, which also I have actually seen it. That is one thing. And second question, somebody is asking if the chairman will retire on 31st of March 26. If the new independent director was appointed the chairperson, the next board meeting in May 26, where the financial statements are cleared, who will sign the board report? Is it the previous chairman or the new chairman? It is on the day when the board report is actually adopted. There is no question of going back retrospectively or something like that, because that was the financial year end. Because it is the approving date. That is what it is actually allowed. The day it is approved, that should be signed. And another thing is that there is somebody saying, we have seen that in many occasions, the auditors sign the audit report after the board meeting date in with the auditor accounts or the board report is actually approved. They share the auditor report financial in placing at the board. No meeting, but signed financial are shared subsequently with the subsequent date. Since the board report needs to contain the comments on audit report, is above practice valid?
So as far as if we go practically, generally, if you have received the draft copy of audit report, which is usually a practice, the auditor will share the draft copy of the report, which after approval of the financial statement will be considered by the board of directors, and basis that the board of directors report will be approved with the delegation to the directors and to the company secretary to make minor corrections and updations if required for the finalization of the report. Now, if your question is that the statutory auditor is not giving the report on the date on which the board meeting took place, but they are giving a report on the subsequent date, whether this practice of signing a board report on the same meeting will be correct or not, according to me, we should not approve the board report in the same meeting if we are not likely to have the audit report on the same day, because technically, if you will be putting the dates in your AOC4 form also, it will have a problem that your board report is a date prior to the audit report. It should ideally be a date subsequent to the audit report date. That's how the construct is. So we should take care, but as long as we are getting the audit report signed in the same date, but may not be at the time of the board meeting itself, that should be okay. There is a very old clarification from the Department of Company Affairs at that point of time. I think late 50s circular is there, which says that Ministry of Corporate Affairs will not have any adverse view if your financial statement, audit report, and board report are signed on the one same day. Because audit is a continuous process. Audit is not just beginning on the time when the financial statements are approved by the board of directors. In fact, that is the end when the audit concludes after that. So that clarification, I think, will help. So as long as you are able to have the copy in the same day, it should not be a problem. But otherwise, we should accordingly keep the date of signing of the board report accordingly.
Somebody
See,
put
in the
data.
practical scenario, how it happens is that the financial statements which are audited, though the auditors are not signing it, what they do is they initial all the pages and they put their seal also, as if that means from their side it is clear. Only thing is, unless until the board approve the financial statement, they cannot give the report also.
Correct.
That is the only reason which they don't sign it and give it to the company beforehand. So, as Amit has rightly said, based on that initial documents, board can go ahead, approve the financial statements and other reports. And once the board meeting is over, immediately the directors will sign the financial statements as well as the auditors also. That is normally how it happens practically. Second thing is that you might have observed some companies, what they do is they used to say that the board has approved the draft financial statements and has decided to hand it over to the auditors for their report thereon. And then they show an adjournment. And in the same minutes, they continue that. Subsequently, the adjourned meeting, the directors have met. The auditor's report has been placed before the board. Like that, it goes on. As Amit has rightly mentioned, there is a DCA circular was there. And you can have all these reports, the financial statements, as well as the board report and other AGM notices, etc. Of the same date, it is possible. Only thing is the board report can succeed the date, but it cannot precede the date of the approval of financial statement.
Yeah, you
Yes,
answered
Pragati.
you answered one of the question here very clearly. Date of signing board report and audit report can be different. Yes, it can be different, but only thing is, as you rightly said, board report cannot be before to the audit report. That is very clear actually. That is the thing.
Yeah, Pragati, go ahead.
Yeah, so resuming with my presentation, I'll go further to the next slide.
Yeah, go ahead.
You have a lot of slides, so you have to gallop also, huh?
Fundraising or something where dividend may be required to be declared to create its brand image in the market. If that is the case and it wants to have a flexibility in their hand, because once you transfer the money to the reserve, rule 3 comes into picture and your hands are tight. You cannot declare 100% of your reserves as a dividend, as against 100% of retained earning, even of previous year, can be declared as a dividend at any point of time. This is one way to look at it. On the other hand, all your limits under 181A, under 181C, under 186, buyback, bonus issue, all that limits are dependent on amount of money which is kept in the reserve. So the more money you have in your reserves, the more limit you will be enjoying. So depending on your comfort, you have to balance in between, but you have to give a guidance to the management as to how this should be balanced in between.
All right. So these are the small, minute things which we need to keep in mind while drafting the board report. Okay, now if we resume with the rules which I was continuing with. So Rule 8 and 8A of Company Account Rules 2014 further expands the scope and it add on some financial summary, financial highlights, changes in business, appointments and resignation of directors, maintenance of cost records, conservation of energy, technology absorption, and other workplace related compliance, such as I rightly said, POSH and Maternity Benefit Act. So, the key point here is that board reporting today extends far beyond financial statement, as rightly said by Sudhakar sir, and encompasses governance, compliance, risk, and sustainability aspects as well, like these things. So, if I move further to the next slide, the core and one of the most important part of the board report, which is said by Amit sir, is director's responsibility statement. Among all the disclosure prescribes, one disclosure deserves a special attention because it represents board's direct affirmation of its governance and responsibilities. I'm referring to the director's responsibility statement. It serves as a declaration of accountability by the board. Through this statement, the directors confirm that applicable accounting standards have been followed and that any material departures have been properly explained. They also affirm that appropriate accounting policies have been selected and applied consistently and that the judgments and estimates are made reasonable and prudent. The board further confirms that the board further confirms that the adequate accounting records have been maintained or not, and if the assets are in proper safeguard of the company, and if they're able to detect the frauds and irregularities in the company beforehand. Another important affirmation relates with the preparation of financial statement as an ongoing concern, indicating that the company is expected to continue its operation in foreseeable future. If we come to the listed companies, board additionally needs to confirm about the internal financial controls and to confirm that it is operating adequately and efficiently. Finally, the board of directors affirm that the proper systems has been advised to ensure the compliance with applicable laws. So therefore, director responsibility statement is not merely a disclosure requirement, it is the board's formal assurance regarding the integrity of the company's financial reporting, internal controls, and compliance framework of the company. So,
Maybe on the last point, I think Company Secretary has a very large responsibility on their shoulder, where they are going to assist to the board of director in giving this statement. And this is a very big statement where the board is taking a responsibility that they have devised a proper system and process for compliance with all applicable laws, because practically there may not be any system in place, right? Or maybe even if it is in place, how the board of director will ensure that their statement is true and it is not having any adverse liability on their shoulder. So Company Secretary usually gives a comprehensive document which lists out what all laws have been identified to be applicable on the company, how the compliance system works, how the escalation mechanics works in the system, and what are the exceptions. So quarterly, we are placing a quarterly compliance report before the board of director, where exception report is there that these were the non-compliances noticed and have been regularized, and that's how the overall mechanics is approved by the board from time to time, and annually they give a affirmation from the respective head of department that this is how we have achieved the compliance of all applicable laws. Back to back, the board of director will be giving a kind of responsibility statement. So this is just maybe one line item where they are giving a statement, but back working is quite huge and quite responsible, right? The Company Secretary plays a very important role in doing that. There was one more slide, Pragati, if you can go 2 slides back. One point which we came to know just 2 days back. There is one clause, second last, annual evaluation of board, committee, and directors listed public company with paid up capital exceeding 25 crore or more. One fine point, that nomination remuneration committee, if company is having, will always be required to undertake and prescribe the mechanics of doing the performance evaluation. It will provide the mechanism of doing the performance evaluation to the other committees, and the evaluation will be done. But as far as the disclosure in the board report is concerned, that is limited to two category of companies. One, either you are a public limited company with a paid up capital exceeding 25 crore, or you are listed entity. If you are not listed and if you are not categorizing, so maybe you are doing a performance evaluation as per 178, but disclosure under board report in 134 may not be required. So we need to understand actually in what cases, from where the requirement of disclosure is coming. It is not just that 178 is applicable on you, so you will be required to make a disclosure. Voluntarily you do, that's okay, that's not the problem. All right, you can.
Okay, so what is just popping up in my head currently is that many of the companies think that if they cross this certain 25 crores limit, public companies, then only they have to evaluate. But it is not like that. The disclosure is required if they are crossing this limit, but they have to evaluate before also, and every
There
company has
is a concept of charging provision. Charging provision for evaluation is 178. Charging provision for disclosure of performance evaluation parameter in the board report is 134.
Yeah.
So both you have to see from the different lenses, right? When
Yes.
178 is applicable, you have to undertake a particular action. When disclosure is required, that you have to see from 134 standpoint.
Yes, so noted. So I'll just resume with the next slide. So many professionals assume that all board report disclosure originate from Section 134 itself. However, Section 134 is only the reporting provision. The actual disclosure obligation arises from various other sections of the Companies Act and ultimately flow into the board report. For example, the disclosure relating to the annual return originates from 92. CSR disclosure arises from Section 135. Fraud reporting disclosure originates from Section 143, subsection 12. Then we go through the independent directors declaration, which comes from Section 149. Vigil mechanism, which comes from Section 177. Board evaluation and nomination remuneration policy originates from Section 178, as rightly said by Amit Sir just now. Related party transaction disclosure stems from Section 188. Remuneration disclosure arises from Section 149. Secretarial audit disclosures come from Section 204. Similarly, other deposit-related disclosure originates from Section 73, 76, while EPF disclosure arises from Section 144. So, while preparing a board report, professionals should identify all applicable provisions across the Companies Act and ensure that the corresponding disclosures are appropriately reflected to the report. So, I'll just take
Just
you.
one point on the annual report web link, because there could be a situation in case of a private limited company, that company is not having a website. Question always comes, and we have seen the practice that many of the companies are still continuing to attach the extract of board report in the board report. Extract of annual return, my apology. Extract of annual return, which used to be a previous law which has been abolished. Now, situation is that if you have a website, you will be placing your annual return on your website and you will provide a web link while preparation of your board report. If you don't have, then you are not supposed to provide the extract of annual return as a part of your board report. That practice no longer is supported by any provision of law. Now, to give a logic as to why government has mandated a kind of information beforehand, right? Why the concept of extract of annual return or web link of annual return came as a part of the board report? Government was, while drafting the Companies Act 2013, considered that there are certain information in the annual report which are vital for the decision making of the shareholder at the AGM. When we file annual return, we file annual return within 60 days of the closing of the AGM. So that information which is vital for the decision making reaches to the shareholder or have the opportunity to extract only after the AGM happens. So government considered to provide that information beforehand, like what is the attendance of the board of directors in the various meetings and the other vital information with regard to the capital and committees and the other thing. So all those informations are now made a part of your board report so that the shareholders can know beforehand while taking a decision with regard to the particular matter. So your board report is not just a report which is in 134, but you have to simultaneously work on your MGT 7 or 7A as well, so that you can put it on the website and a link can be provided beforehand.
Prashant, Amit here, Prashant has put a point here. Section 134, subsection 3A requires every company to mention the web link in the annual report of the company is placed. It means that the board report is approved before the AGM. The annual return is to be prepared before the AGM. But section 92 allows company to file the annual return after the AGM. So how can the company will prepare the annual return before the AGM when the Act points out that within 60 days from the AGM?
There is a concept of harmonious construction. And the harmonious construction says that when you are mandated by one provision of law to provide the web link of the annual return in your board report, you have no option but to prepare that. That means you have to read the section 134 and section 92 in harmony. One section is saying that you have to file. Law is not saying that you file beforehand. Law is saying to prepare. 134 mandate is to prepare and provide a web link and host it on the website. Where is the contrary situation? It is not contradicting. 92 says you file within 60 days of the AGM. Law stands as it is. 134 says that whatever annual return you are going to file, you have to prepare in advance and put a web link and put it as a part of your board report. I don't see that there is any contradiction, and I told you the logic also as to why it is required to be prepared beforehand. What is the logic? Earlier, MGT 9, which was the extract, which was all copy pasted, but the annual report was becoming bulky. So the industry has represented before the ministry that there is no point adding 70, 80 odd pages of extract of annual return. And in certain cases, they were running into hundreds of pages. So they said, all right, we remove the practice of attaching the extract of annual return. We will ask them to just place the return on the website and provide a link in the annual report. So if somebody wants the information, he can go and reach the information beforehand. That is the logic.
Yeah, here Nisha is asking, director responsibility statement that should be taken up in the board in a meeting prior to the approval of the board report, as the board report itself is including this. I don't think there is a director response statement separately taken. It is part of the board report actually. While you are making a statement in the director responsible statement, as you rightly said, then the company secretary has to ensure and give a comfort to the directors, and it is part of the board report, which itself is actually getting it approved. Am I correct?
So I don't mind if company is, as a matter of a good practice, they want to cull out a responsibility statement agenda in a separate board meeting and discuss it out, and then in subsequent meeting they place it before the board as a part of the board report. It is in fitness. As long as you are doing over compliance, there is no problem. There is absolutely no difficulty, but certainly it cannot be done afterward.
Yes, Pragati, you go ahead. Yeah. There are more questions, but we will take it. Go ahead.
Okay,
I
okay.
think there is, Bala sir, there is one more question which somebody has asked. Many times the statutory auditors are asking the board report prior to issue of their report. There is a dilemma in the mind of the people many times, that why this statutory auditor is asking about this copy, draft copy. So I'll just tell ki the reason why it is being asked is the SA 720. SA 720 is the auditor's responsibility relating to other information, which they are bound to adhere to. So in the wish to comply SA 720, they ask the company to share the draft of the board report so that they can understand as to what all developments and the other information which are relevant and material for their finalization of the audit report, they can understand and they can prepare their report accordingly. That is the reason why, and we are providing that copy as a matter of practice to let them comply with SA 720.
Just for the sake of clarity, FS 720, what Amit you are referring to is nothing but your financial statements are talking about the situation as on 31st March.
Correct.
In case of board report, you have to also talk about any kind of significant things happened from the closure of the financial year till the date of the board report, if anything is there. That is what exactly. Sometimes the auditors also having a responsibility to talk about the post, what's called as a closure events, if any. Auditors have to comment about that also.
Yeah.
Amit, here actually a question which is actually coming is he is saying that it is my view. That is what he is saying, Aravinda. Auditor will audit which financial statement? Is it the draft financial statement prepared by the management, which is actually handed over to the auditor for report? Section 134(1) says that the board approval financial statement duly signed by the authorized person should be submitted to the audit for report. But in practice, the same board meeting, the FS is actually approved and the auditor report is received and the director report is also placed in the same meeting. There is no time gap between the board report, audit report and the board report. In government company, the auditor is not starting the audit unless he received the duly signed financial statement. Therefore, in my opinion, instead of doing everything in the same meeting, there should be some gap. I think you
I'll
explained
clarify
this.
again. We clarified earlier also. I clarify it again because this is a very common misunderstanding amongst the people. Audit is not one-day job. Audit is a continuous process which starts from 1st of April of a financial year and continues until your finalization of your audit report, right? So it will not be that we will prepare a audit report on 30th of May of 2026, or we will get the financial statement on 30th of May 2026 and then we will start the audit. I will be doing my audit parallelly. I will be completing my audit observations. I will be ready with everything. I will be discussing with the management. I will be sharing my draft observations with the management. I will be getting their responses on the same. It is only that of formality as per section 134, because I cannot issue my audit report unless and until I have a authenticated copy of the financial statement approved by the board of directors. That is the copy which is final, because board has the ultimate responsibility and authority to give approval to the financial statement. Once they approve, then it attains a finality, and then the auditor will take a cognizance of that particular number and will continue with the report. Normally there is no change, but even if there is a change, then to that extent he will have a responsibility to modify and see whether any audit report observation is required to be undergone change or not. So as long as private sector is concerned, this practice is perfectly all right. As far as the government company is concerned, in government company, what happens in many of the cases we have seen, and invariably in all cases, they insist on getting a signed financial, and usually the audit report is dated afterward the date of the financial statement. Because there is one more audit also, the auditor is also appointed by CAG, and there is a supplementary report which is required to be issued by CAG. So CAG report will be separate and the auditor report will be separate. But there is no harm in the case of a government company also that the statutory auditor puts the same date. And in many of the CPSEs, especially, not the state government, CPSEs, you will find out GAIL, ONGC, you will find out that the auditors are doing the audit report in the same day, in which, because they are all listed entity. If their board meeting is on 30th of May 2026 for approval of the unaudited financial, audited financial result and the financial statement, the audit report will also be invariably be of the same date. CAG reports and comment will be afterward.
Yeah,
But
Pragati, you got, I think, yeah. Yes, Amit.
Yeah, I'm saying this should not be a problem. So far, we have not encountered any challenge. But yes, but it is again a choice. If auditor says that, no, all right, I will issue my audit report 15 days after, as long as you are able to do it validly within the frame of time, it should not be a problem.
Pragati, go ahead. You have a lot of things. We are already 12 o'clock.
Yeah. So far we have discussed what laws require the companies to disclose. The next question is, how should these disclosure be structured and presented in a systematic and consistent manner? So this brings us to Secretarial Standard 4. Section 134 tells us what needs to be disclosed. However, it does not provide a structured methodology for drafting and presenting the board report. As a result, companies often adopted different formats, levels of details, and presentation style. Therefore, Secretarial Standards 4 was introduced by ICSI, which was effective from October 1st, 2018. And it was introduced to provide a structured framework that brought a greater consistency and clarity in this reporting. Although currently SS4 is presently recommendatory under the Act, it represents best governance practices and is widely regarded as the benchmark for the quality board reporting. Let us just go to the next slide and look how SS4 structures the contents of the board report. The first part of the board report focuses on company-specific and financial disclosures. These includes financial summaries, dividend information, transfer to reserve, capital structure changes, and major business development during the year. As rightly pointed out by Sudhakar sir, Secretarial Standard 4 specifies even if there is some dividend declared or anything, even if it is not, it has to be specifically mentioned in the board report that this has been done or this has been not done during the year. So SS4 encourages the company to provide meaningful information about their business environments, industry outlook, strategic development, rather than just merely reproducing the statutory disclosure. It also requires disclosure relating to the capital and debt structure, including issues of shares, convertible securities, ESOPs, equity shares, and debentures. So, from a stakeholder's perspective, these disclosures help to explain not only how the company performed, but also the context in which the performance was achieved. This makes the board report far more informative rather than a simple compliance report. In the next set of disclosure, SS4 focuses on governance and compliance areas. These include declaration from independent directors, comment from auditor qualification, information relating to subsidies and associates, deposits, loans and guarantees, visual mechanism, and material order. One noteworthy aspect of SS4 that it discourages generic disclosure. For example, if the company has not accepted deposit, the disclosure should still clearly state the position rather than remaining silent. Similarly, if there are auditor qualification, meaningful explanation should be provided instead of generic references. This emphasizes on clarity and transparency as one of the strongest features of SS4. Another important area, if we go to the next slide, is about CSR, risk management, and related party transaction. Everyone knows these three other major core areas which are looked upon in the new Companies Act 2013. CSR disclosure have become increasingly significant in this framework. Companies are expected not only to disclose the amount spent, but also the committee composition, policy details, and reason for any unspent amount. Similarly, risk management disclosure should go beyond the boilerplate statements and highlight key risks faced by the organization and measures adopted to mitigate them. If we come to the related party transaction, it continues to attract significant regulatory attention. Therefore, disclosures should clearly distinguish between the arm's-length transaction from those requiring additional justifications and reporting. The common theme across all the disclosure is transparency. Okay, so if now we move further to the next slide, we come to the management and remuneration. Board report is not only about the company, it is also about the people who are responsible to govern and manage it. Accordingly, the secretarial standard first required disclosure relating to the appointment, reappointment, resignation, cessation of directors and KMPs during the year. It also requires the detail of board meeting, annual performance evaluation, committee composition. One area that often attracts significant stakeholders' attention is the remuneration to the directors. For a listed company in particular, stakeholders increasingly examine whether the executive remuneration is aligned with the performance of the shareholder interest. Therefore, disclosure relating to remuneration ratios, percentage increases, top employees, and other prescribed particulars must be presented carefully and accurately. So, from a governance perspective, these disclosure promotes transparency and enable stakeholders to assess whether the compensation practices are fair, reasonable, and aligned with the company's long-term objective. Now, let's take one step further with the next slide. So, while the management disclosure focuses on the governance and accountability, secretarial standard also requires disclosure relating to certain special compliance areas that have gained increasing regulatory attention in recent years. The first one, which I will go with the insolvency proceedings. Where any proceedings have been initiated under Insolvency Bankruptcy Code, details of such proceedings and the status are required to be disclosed. Similarly, details relating to one-time settlements with bank and financial institution must also be reported wherever applicable. A particular important development area relates to workplace compliance disclosure. As many of you are aware that Companies Account Second Amendment Rule 2025 has significantly strengthened reporting requirements under POSH Act. Companies are now required to disclose specific data relating to complaints received, complaints disposed of, and complaints pending. Likewise, an explicit statement regarding compliance with provision of Maternity Benefit Act 1961 is now required. So this pretty much covers up what are the disclosures which are required under Secretarial Standards 4. It provides a detailed structure for each and every disclosure, whichever I mentioned in the past 3 slides. If we move ahead, I just represented you about how the disclosures, what are the disclosures that are needed. So now, when the preparation of a board report is important, what equally important is that ensuring that report is approved and authenticated in the prescribed manner. As already discussed by Sudhakar sir and Amit sir, approval of the board report is one of the important things, and if there is some discrepancies in the approval, the whole report may be not be considered as good and there is a non-compliance. So once approved, the board must be signed by the chairman if authorized by the board, or by 2 directors, one being managing director or whole-time director, and by the CS if appointed. One exception is there that for one person company, there is only one director who needs to sign the board report, as the minimum requirement of directorship in one person company is just one. So in practice, defects relating to the approval and signing are far less common than disclosure deficiencies, but if they occur, it can affect the validity of the reporting itself. I'll take you through the next point, shifting the focus to the next slide, which are other requirements which are filed. Now, once the board has been approved and signed, the next steps involves dissemination and filing. Let us see the requirements prescribed in this regard. After approval, the board report forms the part of annual reporting package sent to shareholders. As we all know, it is attached with the annual report and it is circulated to the shareholder. For the most of the companies, the time frame is 21 days notice, 21 clear days notice rather, I would say. But for one person company, it is 14 days. The report is also required to be placed on company's website if there is any. Apart from the circulation to the shareholder, filing obligation must also be complied. So, the board report and financial statements are together filed with the ROC along with the annual filing forms. Additionally, to the listed entities, additional obligation is there that the same has to be intimated to the stock exchanges, which is equally important. So, if I move to the next one, as Sudhakar sir was saying about the signage of the annexures of the board report, I would just like to highlight the key annexures which are important and which forms an integral part of the board report. So, some of the commonly encountered annexures include AOC 2 relating to the related party transaction, Secretarial Audit Report, that would be MR3, CSR Report, remuneration disclosure, and details relating to conservation of energy and foreign exchange earnings and outgo. One practical issue that professionals frequently encounter is the omission of the annexures that are legally required. In some cases, the main report may be complete, but a mandatory annexure is either missing or not properly authenticated. Therefore, while conducting a final review of the board report, it is always advisable to verify both the main report and all supporting annexures altogether. So far we have discussed the requirements applicable under the Companies Act and Secretarial Standards. However, for the listed entities, they are subject to broader disclosure framework under the SEBI listing regulation, that is LODR requirements, which came in 2015. For listed entities, one of the most significant disclosure is corporate governance report, which requires detailed regarding board composition, committee structure, attendance records, and governance practices. Then there is annual secretarial compliance report, which needs to be filed to the stock exchange within 60 days after the end of the financial year. Another important component is management discussion analysis report, commonly known as MDAR. This provides management perspective on industry developments, opportunities, risk, operational performance, and future outlook. In addition, eligible entities are required to provide business responsibility and sustainability report, or BRSR, which has become India's primary sustainability reporting framework. Collectively, these disclosures provide investor with a comprehensive understanding of the company's governance, strategy, and sustainability practice. Now we will move to the next part of slide, that is the certifications required under the SEBI LODR regulations. One of the most important requirements for the listed entity is CEO and CFO certification. Through this certification, the senior management confirms the accuracy of the financial statement, adequacy of internal control, and compliance with the applicable law. So, this statement, this certification would be additional with the director's responsibility statement. Director's responsibility statement has to be certified by the board of the director, that is from all the directors of the company. However, for the listed entities, specifically CEO and CFO, which are the KMPs of the company, they also need to certify that the internal controls are adequate and there is a compliance with applicable laws in the company. Listed entities are also required to obtain corporate governance compliance certificates from the practicing professionals. Further, several disclosures are now web link based, requiring company to maintain update information on their websites. Dividend distribution policies, investor grievances information, and other prescribed disclosure also form part of overall reporting framework. The key takeaway is that annual reporting for listed entities is no longer limited to statutory compliance. It is involved into comprehensive investor communication exercise. Coming to our next slide, so far our discussion has largely focused on the Companies Act and SEBI regulation. As rightly said by Balakrishnan sir, the main core content of the board reporting, however, comes from Section 134 of the Companies Act. Depending on the nature of the business sector and regulatory environment, disclosure may also arise from labor law, secretarial regulation, and governance framework issued by the specialized regulator. A common example is POSH Act. Following the 2025 amendments, companies are now required to provide specific information regarding the complaints received, disposed of, and pending. Similarly, compliance with the Maternity Benefit Act must now be expressly confirmed. For NBFCs, RBI regulation places significant emphasis on governance, risk management, and asset qualities. Banks are required to comply with RBI corporate governance framework, which focuses on board oversight, fraud monitoring, and risk governance. If we come to the insurance companies, they are subject to NHB and RBI regulations. Insurance company must comply with the governance requirement prescribed by RDAI, and housing finance company are subject to the NHB and RBI directions. Government companies and CPSEs are additionally guided by DPE corporate governance guidelines. What this means is that practice of the board report has evolved beyond the Companies Act compliance document. It has a comprehensive compliance reporting document reflecting the compliance of multiple legal and regulatory framework. And for us, company secretaries, this requires a much broader approach to disclosure mapping. A disclosure checklist must be prepared only with the reference to the Companies Act is no longer sufficient. Now, taking the discussion forward, I would turn our attention to the most recent regulatory development affecting the board reporting. The Companies Account Second Amendment Rules 2025. This marked an important shift in the approach adopted by the regulators towards the corporate reporting. Historically, the board reporting was largely in narrative in nature. Company would provide descriptive disclosure and compliance confirmation. And the 2025 amendment indicated a transition towards data-driven reporting. Specific information relating to POSH and Maternity Benefit Act compliance must now be reported in a measurable manner, At the same time, integration with the MCA V3 ecosystem reflects the increasing use of technology in the compliance monitoring and regulatory oversight. So, if in simple terms, I must say, regulators are moving beyond reviewing the companies to disclose what are they are increasingly focusing on is to validate the underlying data supporting those disclosure. Now, as the disclosures are becoming more detailed and data driven, the cost of non-compliance also increases. This brings up to the consequences that companies and officers might face for deficiencies in reporting. So, what happens if we might slip up? Apart from the flat section 134 subsection 8 penalties, that is 3 lakhs for the companies or 50,000 per officer, listed entities face SEBI penalties up to 1 crore, trading suspensions, or frozen director portfolios. Practically, you face intense regulatory scrutiny, show cause notices, adjudication proceedings, major blow up to investor conferences, and severe blocks during fundraising due diligence for IPO. So, non consequences of board reporting, you might think it's just something that we have that might have slipped off to your head, but the consequences are pretty much huge. So, with the next slide, to understand how regulators are approaching these issues in practice, let us examine a few real life enforcement cases. These cases demonstrate that penalties of board report deficiencies are not merely theoretical. First case relates to the Interlinked Export Limited. In this matter, the secretarial audit report was not attached for 6 consecutive years. At first glance, this may appear to be an omission to of an annexure. However, regulators treated it as a serious non-compliance because secretarial audit reports forms an integral part of the disclosure framework. Plus, the board also have to give references about the observations that are raised in secretarial audit report. So it is a pretty much important compliance that needs to be done by every company. So the resulting penalties was like in total 36 lakhs. And it extended not only to the company but also to the CFO and company secretary. The lesson here is straightforward. Annexures are not optional attachment, they are essential component of the board reporting.
One thing you have to take note of it from here, when they say CS is actually 12 lakh rupees, the money is actually going to go from the pocket of the CS. Because order very clearly says any penalty levied is to be paid from their own source of income out of their own pocket. Please keep this in mind. Yeah.
Yes, sir. Now, if I come to the second case, which concerns the TBF Nidhi Kumbhakom Limited, here the auditor has raised qualification regarding compliance matter. However, the board failed to provide explanation as required under this section. The regulator view was clear. If auditor raises concern, the board must respond to those concerns through meaningful disclosures. And the penalties were heavy. If I come to the third case study that relates to Muthoot Mini Nidhi Limited, the company failed to attach Form AOC2, which is related to related party transaction. They also omitted deposit related disclosure and failed to provide the disclosure regarding to the compliance with secretarial standard. What a particular noteworthy is these omissions continued over years. As a result, penalties became substantial. This case illustrates an important principle. Recurring non-compliance is viewed far more seriously than isolated errors. The fourth case concerns Lyon's Coordination Committee of India. The company failed to disclose the number of board meetings held during the year. Many professionals may consider this as a basic disclosure. However, because the board report is intended to provide stakeholders with visibility into governance practices, the omission attracted significant penalties. The key takeaway is here that there is no concept of small disclosure in board reporting. So, a disclosure, if it is mandated by law, its omission can lead to enforcement action. Likewise, I have covered a few more case studies. If the panelists agree, I'll just cover all, or I'll just go on with few overview of few of them.
No, one thing is there, you can just only read the heading, because you see, the whole idea is, it is not only the company side, it is very, very clearly everything. Even there have been cases on the ports, there have been cases on non-disclosure of, medium and
MSME.
small scale industries. Like that, it is actually running through. They are very seriously looking into various issues. These are all only to highlight and bring to the notice of the people how care one has to actually take care of it. Number one. Number two is, as you rightly said, whether it is a small one or bigger one, there is no discrimination. Ultimately, everything is
Exactly.
viewed serious, and the penalty is very, very clear. If you go by section 134, subsection 8, it very clearly says 3 lakh rupees for the company, 50,000 rupees for each of the officer. It is very clearly says it's going to be a heavy penalty. That's it. Yeah. You can
Okay.
just run through the headings.
Yeah. So next, there are cases regarding the non-disclosure of CSR non-spending reasons. The company has failed to disclose the reason for non-spending of CSR amount. That
Yeah,
led to
this particular case is the old case, I think, because when the CSR was introduced, if you all remember, when the CSR was introduced, that time the law was worded in such a way that if you don't spend the money, it's okay, there is no problem, there is no violation. But the thing is, if you don't give the reason why you're not spend, then that is a violation. That was actually the rule. And I think subsequently the regulator realized many companies are taking this route and they are not spending the money. So law has been subsequently amended to that. But I think this case was earlier to that when that explanation was not provided. Yeah.
Okay, then there was failure to attach AOC2 and other mandatory disclosures. Then, as rightly said, there was one case for non-disclosure of POSH compliance. So I'll just brief this one, that in matter of Kandan Mutual Benefit Swastha Nidhi Limited, the company failed to include the mandatory statement regarding compliance with the provision of the POSH Act in the board report. The board failed to disclose the compliance relating to the internal complaints committee under the POSH Act. Therefore, the lesson from this case is very clear. POSH disclosure are not optional narrative statement, they are mandatory statutory disclosure and must be reviewed with the same level of diligence as financial governance and disclosure as mentioned in the Companies Act. So, as rightly said by Balakrishnan sir, the penalties and the fines which has been imposed by the regulators are not only from the Companies Act itself or from the SEBI LODR regulation, it arises from different other regulators and other acts as well. So, if I move ahead now and look at the actual, now that we have looked at the actual enforcement actions, let us examine some of the most common drafting mistakes that led to these compliance failure. In my experience, most board report deficiency do not arise because company deliberately avoid compliance. They arise because of weak drafting processes and inadequate review mechanism. So one of the common issue in the use of previous year report as template without properly updating facts and disclosure. So some of them just copy paste the previous one and they just omit to change what are the facts that has been changes throughout the year. Other frequent issue is providing generic responses to auditors' qualification instead of meaningful explanation. Some companies also tend to overlook annexures such as AOC2 or fail to reconcile CSR disclosure with audited financial statement. With recent amendments, POSH disclosure will likely to become another area to focus. So, as a company secretary, we should consider these mistakes as opportunity to strengthen our internal review processes. A practical solution is maintaining a detailed board report checklist that is reviewed every year before the draft is placed before the board. Likewise, if we see from the other part of the dais, that is from the secretarial auditor's point of view, we should also have a checklist with ourselves so that we will get to know what are the points that must be applicable to this type of company, including with the other regulatory checklists, so that we get to know what are the omissions made by the company. I'll take you to the next point, to the next slide. All of these cases and mistakes point to a broader governance principle, which is corporate scandals rarely begin with disclosure failures alone. But disclosure failures are often the first visible signs of deeper governance weaknesses. This code highlights an important reality. Poor disclosures are often symptoms rather than the root cause. As company secretaries, our role extends beyond drafting. We act as a governance professional who help to ensure that disclosure accurately reflect the underlying reality of the organization. Therefore, whenever we review a report, we should not merely ask whether the disclosure has been included. We should also ask whether it is complete, accurate, and reflective of the company's actual position. This brings us to some of the most significant corporate governance failures in Indian corporate history and lessons they offer for board reporting. Cases such as ILFS, Yes Bank, DLF continue to be discussed because they demonstrate the consequences of corporate governance failure on a very large scale. Although the facts of each case differed, they shared a common theme: gaps in transparency, disclosure, and oversight. In case of Satyam, financial information reported to the shareholders did not reflect reality. There was false financial figures. In case of ILFS, risk disclosure failed to adequately communicate the seriousness of underlying issues like liquidity risk and unexplained RPTs. And Yes Bank, governance concerns and concentration risk was not reflected effectively in management discussion analysis report, which is a public reporting. In DLF, regulatory authorities identified deficiency relating to the disclosures concerning related parties and subsidiaries. The lesson from these cases is that board report is not merely a statutory requirement, it is one of the most important governance communication tools available to the board. A well prepared board report strengthens trust, a deficient one undermines it. Now that I have reflected on the past failures, let us now look ahead and understand where board reporting is heading in future. The future of the board reporting will be shaped by four major trends. First is digital reporting. With the MCA V3 ecosystem and increasing use of structured reporting formats, compliance is becoming more technological driven. The second trend is the growing importance of ESG and sustainability reporting. Investors today seek information not only about the profitability but also about government and social performance. The third, regulators are increasingly focusing on the disclosure quality rather than merely of the disclosure quantity. Boilerplate language is gradually be replaced by expectation of meaningful and company-specific reporting. Finally, regulatory oversight itself is becoming data-driven. Technology enables regulators to identify inconsistency and anomalies much more than efficiently than before. And in my past experience, I have seen NSCs giving cautionary notices to the companies wherever they find discrepancies in the board report, or if the company has not disseminated the board report as required by the law. So this is the thing that one has to keep in mind. As governance professionals, we must prepare ourselves for this evolving environment. So, as I conclude today's discussion, I would like you to leave you with one final thought that, in many ways, board report serves as the voice of the board. Therefore, every disclosure included or omitted sends a message about how company is governed. As company secretaries, we play a very critical role in ensuring that this message is accurate, complete, and compliant. As a well-drafted board report does not merely reflect the record of what company achieved during the year, but also a reflection of how responsibly it was governed. Thank you so much for your time today. I'm not happy to open the floor for the panelists to just.
Pragati, excellent presentation what you actually made. What is
Thank
coming
you,
out,
sir.
all those things are board of directors are being, the relationship as a trustee or stewardship or agent, whatever you call it. they are actually bound to give what you call annual progress report. What we used to get in our school days and college days. That is what they are supposed to give to the shareholders of the company. So, as you rightly put it, it should be complete, it should be correct, it should be accurate. That is what it is there. It should address various issues. That is one thing. Second thing is, as you rightly say, everybody will be proud to be associated only with those companies which are actually practicing good governance practices. They become very selective. People don't want to just go any company which is giving a better return. People simply want to see whether it is a compliant company, whether it is a good governed company, whether it is a good ethical company, whether what they are doing ethically, everything is being done. That is what they are looking after. That is the bottom of the matter. I think with this, we will start looking into the question. There are a couple of questions which are actually there. Let us see. Let's start from the very beginning. Can we get the financial statement about it here elaborately? We have seen the audit report signing, that also we have talked about it. Webling also he has explained very nicely. Here there is a question has come here. It seems to be a little personalized question. I signed the financial statement of the listed company in the year 2019 as a company secretary in employment. There were some non-disclosure of the bank interest, director report, etc. ROC has actually filed a criminal case against the court, against the company secretary and others, as has signed the financial statement. 7 years have actually gone by, and as the company has closed, no one interested. Please guide me what I should do.
I think there is a decided matter, if I'm not wrong, by the Supreme Court on the signing of financial statement and the responsibility of a company secretary in that case. So the crux is that he is signing to authenticate that this is the copy what was placed before the board. Not beyond that. He is not signing and vouching the financial numbers. So I think he can take benefit of that judgment, and it can help him out in coming out of this.
1 minute, Amit. In fact, if you see the question, there is something short in director's report, not in the financial statements. So I don't know exactly. They said that there was
But
some
why company
non-disclosure
secretary
of
will
bank
sign?
interest. No, in the director's report, suppose if the director's report there is some lapses there, it may be amounts to non-compliance, then the company secretary will also be held responsible for that.
Yes, absolutely.
So in such case, the possibility is that unfortunately, I don't know, Pragati has not touched that subject. There is a scope for revision of the board's report in the Companies Act 2013.
131.
Yeah,
Yeah.
they
Okay,
have
so
mentioned it in
now
the
what they can do is, in this particular case, if there is a lapse or a non-compliance as far as the board report is concerned, unlike financial statements, for board's report, the time period is not given. That's why, according to me, they can revise the board's report and then get over with this particular non-compliance, if any.
So window is same for 3 years only. For financial
Is
statement
it
and
there
for
for
board.
board's report also? I'm not
Yes,
sure about that.
yes,
Okay.
same. 131 same.
Then it is not possible then.
Yeah, here in this case, it seems to be a little difficult because the problem is here, the company seems to have been closed. That is what he is saying here. It is 7 years, number one. Number two is the company seem to actually close. That is the thing. And he said there is no one interested. That's what he says. I really don't know. Section 134(3) subsection F, why the word auditors also include the cost auditor or only statutory auditor?
3F is with regard to the reply to the qualification, Pragati. Is that so? If yes, then it will be including the secretarial auditor and the statutory auditor.
Yeah, that is
See,
right.
a cost audit report is internal to the management. Cost audit report is not addressed to the shareholders.
Yeah, cost audit is also applicable only to the specified industry, not for the all
But whatever
industries.
maybe if it is applicable and even if there is a qualification, the address to that goes in the CRA form, which is to be filed with the government, right? It is an internal and confidential report. It does not appear in the public domain.
Yeah, you're right. Accounts are opted in May and the director's report is in August in the listed company. Is it correct? Accounts are approved in May and the director report is in August.
Possible, no
It
problem.
is how to record in the board report if the director or the MD disqualified as per the section 164 subsection 1D, but not vacated is asked, provide the section 161 1F. Please clarify. Also, please confirm whether he can sign the financial report, director's report, etc. if the board authorizes him to sign.
If a director is disqualified, it is automatic vacation of office. Now, where is the question of his resignation and all? Under 167, if there is a disqualification under 164, I think it is a vacation of office.
Yeah, but Sudhakar sir, there is one more point. You will not be vacating from the company where you have defaulted.
Yeah, that is correct. That I agree. That I agree.
So, as far as your right to resign is concerned, you have a right to resign.
So then
Whether
he can sign it. Now, see, till the time he is the director of the company, as you rightly said, Amit, that he can continue as the director of that particular company.
correct,
If he is a director, if he is authorized, he can sign the financial.
correct.
Some of the contents is not applicable in the company, that is ease of deposit. In such a cases, is it required to disclose not applicable, or we can leave these items?
We have
Pragati,
to
stop
disclose that.
sharing your screen.
Okay.
Yeah.
So, Bala sir, they have to make a disclosure that it is not applicable.
Okay. In my views, under auditor will audit the file. So this we have seen actually. PPT sharing. People have been asking whether PPT can be shared. Please note, PPT is actually not shared. The entire webinar is actually recorded. The recorded webinar is actually disseminated. It is available on the YouTube that you people can actually access. That you can do that, which contains the PPT. Whether the website blower mechanism, with the whistleblower mechanism, this status of the complaints, like number of complaints received, whether closed, open, etc., nothing mandatory to form in the director's report.
What was the
Sir.
question? I couldn't understand, Bala.
No, whistleblower
You are losing your voice in between.
Yeah, correct.
is the number of complaints received, number of complaints.
No, Bala, you are not audible. You are on mute now, Bala.
Yeah, he is asking a question in a whistleblower mechanism with a complaint which is received or resolved, what is pending, whether that is actually required to be disclosed in the board report. That's what he is asking.
So the whistleblower mechanism works like as per policy. The person who has blown the whistle, the complaint will go to audit chair. And as per policy, the disposals will be done as long as it is in frame of that policy. It is not requiring any disclosure. But anything where you have not adhered to your policy, deviations are there, those deviations will be part and parcel of your board report.
Yeah, as you rightly say, the whistleblower mechanism complaint, which is actually received, is looked into the audit committee, and they resolved it. They actually report it back as per the company's policy. That's what I think so.
Correct.
So really speaking, it's nothing in the board report as such, as you rightly said. Sir, can you please give the Supreme Court judgment to enable me to do the needful? No, but he already said, the Supreme Court judgment will be applicable only in the financial statement, not in the board report. That's what he actually said here, because I don't think this
In any
case
case,
is
we
going
will
to
share that judgment, no problem.
Okay. What is the liability of the independent director in many of the such internal non-compliances?
The liability of a
Independent director.
so independent section 149 gives a immunity to the independent director only in the carve-outs which are created therein. So if it is not as per the board process, if it is not without his connivance, or if it is not within his knowledge, then only he can claim the exemption. But if he is remaining silent, by remaining silent, the independent director can't claim immunity. But
regarding
as a matter of practice, the officer in default definition, words like that, there will be if there is a whole-time director will be officer in default. Then if there is a KMP, then KMP will be officer in default. And if any one of the non-executive director is nominated as a hold officer in default, he will be nominated, he will be considered. If none of these actions are there, then only the independent directors will come into picture as a officer in default. So you have to consider in what scenario you are talking about.
Regarding signing of the financial statement and the board report, can these be signed by the director who are absent from the meeting where these were actually approved? For example, MD is
Absolutely no
absent.
problem. Absolutely no problem.
Okay.
Authentication, it is only authentication. Somebody is authenticating, that's it, by delegation of power.
Okay. Regarding the financial statement of the board report, can this be signed by the director, Achak, who are absent that we talked about it? 1 minute, let me move further. Will a NSC limited subsidiary be governed by the same provisions of the filing along with the secretarial audit report? Please show some light on this. No, when you say listed company, whether it is NSC or BSC, it doesn't make a difference. It is only the listed companies. But only thing is what he's saying, NSC listed companies subsidiaries. Yeah, he's asking the question subsidiaries.
So if it is a material subsidiary, 24A provision will become applicable. The SEC audit will be applicable. If it is not, then it will be a plain vanilla unlisted company.
Okay. Whether the loan taken from the RPT shown in the loans heading or related parties heading under the board report or both?
No, in AOC 2, I think there are many questions on AOC 2. Let me clarify. AOC 2 is applicable only in respect of items which are falling in 188. Items which are not falling in 188 are out of the purview of AOC 2. Which are those items? There are only 7 items which are falling in 188. Sale, purchase, supply of goods, services, leasing of immovable property, sale, purchase of immovable property, and likewise. So loan transaction is out of 188 transaction. AOC 2 does not figure these type of transactions to be reported. Number 2, there is again a myth that the transactions which are in ordinary course of business and arm length, for which the approval of the board or the shareholder is not required, are not required to be reported in AOC 2. It is not so. The reporting is done on 2 parameters. One, all transactions which are non-arm length basis. Even 1 rupee transaction on a non-arm length basis will be required to be reported in AOC 2. Second, all material transaction. Whether you are required, how materiality has to be tested, you know how the materiality has been defined. So if the transaction is material, typically 10% of your previous year turnover, then irrespective whether you are required to take any approval of the board or shareholder or not, you will be required to make a reporting. There are, I think, many of the orders of adjudication where ROC has levied the penalty on AOC 2 non-compliance itself. I think Sana Lifestyle was one very recent in the April. Bala sir has written article on that also. And likewise.
Yeah,
transactions which are on arm's length basis.
Yeah, you are already addressed all the AOC2 questions. I believe there are a couple of questions are AOC2, saying that what are the disclosure related construction board report. You said very clearly it's on 88. One more thing is raised. With respect to the disclosure in RPT in AOC2, material transaction and ordinary course of the business arm's length basis, I have a query on this. If the holding company does RPT with a wholly owned subsidiary company, which is fully exempted for approval, etc., under 188, do I still need to disclose in the AOC2 attachment in the board report?
If material, yes. Same principle applies, what we discussed just now.
Krishnan says, remember the word in Narayan Murthy where when in doubt, disclose. That's a very good quote. Is it mandatory to sign the board report by the employee company secretary? If the company
Secretary
does
is not required to sign the board report.
If the company does not have any RPT, which are material, which are not in the arm's length basis, then nil disclosure in the AOC is okay, your view.
Yeah, absolutely. If you don't have anything, you have no non-arm length transaction and no material transaction, then it will be nil.
ABC Private Limited is making a disclosure of the details of all the contract arrangements with related parties that are non-arm's length basis, and also details of all contract arrangements that are arm's length basis but materials in AOC2. However, ABC makes a disclosure only with respect to the item covered under section 188 of the Act. ABC is of the view that by virtue of the fourth provision, section 188(1), all transactions which are in the ordinary course of the business and all arm's length are exempt, are not required to be disclosed in the AOC2. What is your view? I think just how you explained this. You said
Sana
actually 188 all
Lifestyle,
the seven. Yeah.
yeah, Sana matter is live. I think the view regulator has affirmed again, which was specifically mentioned by me. So unfortunately, we'll have no option but to disclose that. Exemption is only from taking approval of the board or shareholder. Exemption is not from disclosure.
Company has both CEO and CMD. If CEO is not signing, can the CMD sign only the compliance report along with the CFO?
I believe he's talking about the financial statement or board report.
He has not mentioned anything, but he says only the question reads
So
only
as far
company.
as board report is concerned, it is requiring only two signatures, either one chairman or MD plus director, or maybe two directors. CEO is out of question.
What is the distinction between web and web link disclosure?
See, web link is giving you the opportunity to directly reach out to the particular file instead of, because now a website is also containing a lot of information. So at times, if I just say that annual return is placed on the website of the company without giving an exact location, the people may not be able to reach out to that destination. But if I give a web link, one will click on that link and the annual return will be open.
What are the disclosure applicable to the company under the process of listing, that is under IPO and planning to file DRHP post AGM?
So the companies which are in process of getting listed, SEBI ICDR mandates the compliance with regard to the governance primarily. So regulation 17 of ICDR provisions will partly hit because they will be required to do the independent director's appointment and certain other compliances. To that extent, your board report will also be including these disclosure. Other than that, everything else become applicable only once you are listed.
Yeah, you're absolutely right. Because LODR will become apply only the company goes for the listing. But before that, what are the requirement, your preparedness, that will apply. Yeah. If the company keep the board report and other annexure digitally signed or just by making SD, is this valid?
Digitally signed document is valid in terms of information technology law. There is absolutely no problem. But mind you, the digital document has the validity only in the digital world. Digital document has no meaning and significance in the physical world. So if somebody asks you a physical copy, then you will be in difficulty that from where you will get that physical copy. It will be required to provide a certified true copy of the digitally signed document. Then it may be considered valid. Otherwise, in digital world, it is okay. As far as SD practice is concerned, I think that practice ministry has time and again clarified. And now again, when they have came with the version 3, they have specifically mentioned that they need an authenticated copy to be attached. So please don't continue the practice of attaching a board report with the SD.
Another thing he has actually said that marking it SD, is this valid? Marking it SD is not valid. I have seen the cases, people are filed simply SD. It said it's an unsigned report.
Yeah.
So it is open for penal actions. Small company, any restriction of signing of the same by one director or what it says?
No, the 134 is same for a small company and for big company.
Okay. RPT transaction, you have talked about it.
There was only an exception for OPC that the board report was required to be signed by one director. Otherwise, there is no exception for small companies.
Yes.
Do company need to take a prior approval from ROC MCA to avoid disclosing top 10 employees remuneration in the board report? Is it mandatory to disclose this otherwise?
A very good question. In fact, ROC has no power to grant exemption in respect of these matters. And this is a point of debate, especially among the big listed entities, as to how to do that disclosure. As far as the law is concerned, the disclosure is mandatory. Few companies are having a practice that they put it on the website and the link is provided. Few companies mention that necessary informations will be provided on need to know basis. But as far as the law is concerned, the law is very clear that we have to disclose.
Please elaborate the technology absorption disclosure and the conservation of energy for basic sector companies.
So this disclosure earlier was applicable for certain class of companies prior to Companies Act 2013, but after that, this is applicable on all companies. So technology, why government is concerned on these two aspects. One, government has a lot of focus on indigenization. Suppose you have started a joint venture company where you have taken a technology from Germany for manufacturing the automobile. So how much indigenization you have done over a period of time in adaptation of that technology? They want the status update on the same. As far as the conservation of energy is concerned, this provision is also applicable on all. Not necessary that you have to be in manufacturing segment. Even if you run an office where you have a 10 kilowatt consumption every month, so maybe by changing the lights to less power consuming LED devices, you can save the power. And likewise, the heavy motors can be reduced with the small motors. So whatever effort, even if you don't have any further thing whereby you can reduce the power consumption or make the conservation of energy, you can simpliciter write a one line that company has optimized its power consumption and there is no scope for further improvement in the reduction of the power. But you have to mandatorily make that statement. We can't say that this is not applicable.
You are absolutely right. Actually, in fact, I have come across with some of the reports where the ROC has taken. Actually, they says this we are actually some IT company or something. This is not applicable when it comes to the power energy. ROC has taken it left and right. He says, what is this not applicable? You are using the light, fan, AC, conditioner, etc. And also alternative use of energy is possible. Solar is possible. You are instead of talking all those things, you are talking like that. That is what the things have actually come in one of the order. Yeah, you are
So,
absolutely right.
Bala, I take your leave because it is midnight for me. Okay.
Okay, sir. Have a good
Bye,
sleep.
Amit. Good night.
Good night.
Why so?
Thank you.
Thank
Yeah.
you.
Thank you very
Thank
much.
you. Thank you. I appreciate your efforts joining. I think we are done with all the questions. Now we can see anybody has risen the hand here. If anybody has risen the hand, we can address to them. But as of now, I do not see any hand actually risen. But one thing is there, Amit, let me tell you one thing. There is one hand is risen. In spite of practicing company secretaries, conferences there and other things, even at this particular time, we can see 220 plus
Yeah.
participants who are there actually.
Absolutely.
That really shows the importance of the topic. That really shows the urge of learning. This really shows the youngsters coming forward more and more, know the things. I really appreciate that with the youngsters. There are two people, I think Krishnan is risen the hand. And again, Ravindranath has risen the hand. Yeah, Krishnan has put down the hand. I don't know why. Ravindranath, you are there. You can unmute. You can talk. Ravindranath, you are there. Yeah, Krishnan is also there. One of you can unmute and you can talk. Yes, Sanjay also.
Can you hear me, sir, now?
Yeah, we can.
Yeah. See, in fact, I sent a question. I don't know how I missed out. See, one
Yeah.
of the companies, the board of directors felt that the company is a going concern.
Yeah.
Whereas the auditors, statutory auditor felt that it's not a going concern. So the dilemma is between these two, then which one prevails?
No, there is no difficulty. There are benchmarking with regard to the going concern, right? You may, if a director is having an opinion basis that company is going concern, there may be reasons. Maybe I'll give you the example. The example is that company is not having any earnings for the past 2 years. And auditor is saying ki it appears that you don't have any viable business plan and you have not earned any income from the past 2 years. So why this should continue as a going concern? Why I should believe it as a going concern? Whereas directors may have a business plan in their mind whereon they may be working. So that's why they are saying, and there is something in concrete in the document which suggests that the company will be revived and the business revenue will be generated. So basis that they can give a note to the statutory auditor and they can understand, and auditor I'm sure will be agreeing to the proposition of the board of directors.
Mr. Amit, in one of the cases, there was a real, both of them were not listening. Despite we supporting all the documentary evidences that there is a going concern, but statutory auditors were hell-bent, saying that I want to qualify as a not going concern. So that was the conflict.
So even then, worst case, I understand because at times this kind of situation happens. So at max, he has the right to qualify the report. We can still put our remarks to the qualification of the auditor, saying that in the firm view of the management, because of so and so reason, the company still continues to be a going concern.
Perfect.
Yeah, that you can always put in the board report because you have an option to commenting and putting the things in the board report, which can be done.
Perfect. Yeah. Sir, I have one more question, if you don't mind. See,
Yeah,
now,
no
assuming
problem.
in many cases, some of the chairmen and directors are not presenting at the board meeting where the financial statements and the director's report are approved. However, the other directors pass a resolution authorizing them to sign both financial statements and the director's report when they're absent. Is it valid?
Valid, no problem.
Yeah, it is valid. There's no problem because company law doesn't say. Company law says it should be signed by the people who are there, or otherwise authorized people, they are there. If they are authorized people are there, they can sign. There is no problem.
Perfect. Thank you very much.
Because,
Thank you.
Because they are only authenticating the things.
Yeah. Thank you.
Yes. Sanjay, you can
Sir,
unmute and talk, please. Yeah.
Sir, I've got two questions. Number one is, please, can you give me the Supreme Court order? Because
I
sir,
will
how
share.
will you give me? How will you share? But how will I get it, sir? That's my question.
You can get it from Bala sir.
And sir, how will you give me? Bala sir?
You can text your email ID to Bala sir and Bala sir will provide. Or you may write it in the chat box. I will just note it and I will share it. No problem.
Yeah, you
And
put it in your chat.
question,
Yeah.
second question, sir, was that which I had asked before, the compliance report is for the quarterly accounts. Now, this has to be signed by the CEO and the CFO. Now, this company is a Calcutta-based company, but the CEO stays in Delhi. So the CMD says, I will sign the compliance report in place of CEO whenever the meeting is held. Is it okay, sir?
So who is signing instead of CEO?
CMD.
But why you have designated someone else as a chief executive officer, but chief executive officer is not able to sign?
He's not in Calcutta. He stays in Delhi only.
But that does not matter today. In today's time, a simple email is required now for wherever he is staying. How does that matter? But that does not satisfy the answer.
But if CMD signs, sir, will that be valid, sir?
In the eyes of law, the responsibility has been casted on CEO and CFO, right?
Yes, sir.
Unless
Yes,
there is
sir.
a valid reason whereby CEO is prevented or is incapacitated, is he seriously ill during that particular period, and he is not able to look into the affairs of the company. So the CMD is doing that responsibility during that interregnum period. I can understand. But when both are having a capacity to sign, why the email copy of CEO cannot be taken? That is the question.
Yeah, and today in the digital world, 24/7 sitting anywhere and doing anything, any place, etc. I don't think this will be acceptable. That cannot be a
That should not
excuse for
be
that.
taken a valid excuse. So maybe tomorrow, if exchange is asking these type of tough question, we may be in difficulty. So let us not do that.
Yeah, good afternoon, sir. Sir,
Yeah.
I have one query. Hello?
Yeah.
Yeah,
Go ahead.
am I audible? Yeah.
Yeah.
So, in case a company doesn't have a CEO, but it has a chairman and a managing director, in that case, can the CEO, CFO certificate be signed by the chairman and managing director?
Sonali, can you repeat again? Sorry, I missed the.
Yeah. In a company, if a company doesn't have a CEO, but it has a MD and a CFO, then the CEO,
You can
CFO.
for
Yeah,
the
then MD and CEO should sign. MD
yeah.
and CEO should sign. That's all.
You
Because
can,
see,
for the purpose of LODR, you can designate MD as a CEO for the purpose of LODR compliance.
yeah,
Yes, sir.
it is
Fine, sir.
only the person who's in charge. That's all. Let him be
Yes,
a
sir.
MD, let him be a CEO, whatever it is, it's perfectly okay.
Yes,
Yeah.
sir. Thank you, sir.
That's all. I think we have done with all the questions. Let me also tell you, Amit, there are a lot of appreciation has been actually given in terms of presentation, in terms of deliberation, etc. And all these things. I must acknowledge the receipt of the people's appreciation here. People say excellent presentation, very good things, and they're well deliberated. All those things which are actually coming. Credit goes again to Pragati for the well presentations. I
Thank
take the
you.
opportunity for thanking Amit for sharing the valuable practical experience and dealing the things appropriately time again. Excellent, sir. You have done a wonderful thing in sharing the thing. It's really a knowledge sharing session today, which is added value to everybody. Thanks a lot. I think with this, we will close the session today. I take the opportunity thanking to each participants at this particular time. We are well attended webinar. Thanks a lot to everybody. Have a good weekend. Thank you.
Thank
We meet
you.
next week.
Thank
Thanks
you,
a lot.
sir. Thank you.